In this episode, Investors and Operators, I am chatting with Greg Mayer, who is the head of portfolio operations and a partner at Argosy Healthcare Partners. Greg, let's dive straight into this. All right. So this episode is for maybe other operating partners, small business executives, business owners. And let's just kind of start off with a big question, which is like, what is a blueprint to accelerate growth? How do you do this?
Yeah, so our blueprint for accelerating growth is really tailored to small companies, right? So like that's kind of at the core of our strategy is we work with really small businesses and companies, 1 to 3 million in EBITDA. So it could be 5 million, as small as 5 million revenue, right? So a lot of the elements are kind of similar as working with big companies, but kind of how you accomplish them can be very different in terms of who's doing what. But yes, I mean, like really three pillars of our growth model. The first one is starts and stops with strategic planning, laying out a roadmap for what do we want to look like in 5 years, and really identifying the 3 to 5 kind of value creation initiatives that are going to fundamentally kind of change the business. That's the first step. That's where we start. And then the second pillar is really the foundation, the most important one, which is talent. So that's kind of, again, we start with small companies, small businesses, but typically starting with 1 or 2 like kind of key individuals, and we need to build that out to 4 or 5. And then the last element is platform transformation. Again, kind of a function of how you need to build when you're small. Oftentimes you're not, kind of leaning into the finance function or the commercial function as much. And so the last element of it is really professionalizing those elements and kind of upscaling the rigor and process there.
So let's dive into the first pillar of strategic planning. Like, how can a business owner start to identify those 3 to 5 value creation initiatives that could be executed on the next 5 years? I mean, a lot of us are in our day-to-day business are not thinking about the next 5 years. We're thinking about the next 5 months, maybe the next 5 minutes. So if we are to do this, where do you start?
I mean, that's the conundrum, right? Is that, oftentimes, or really almost in all cases, these, kind of value creation initiatives or strategic initiatives are incremental or kind of like different than doing the day to day, right? So this could be expanding into a different, an adjacent product line, going from one geography to another, hitting one market segment, introducing a new market segment. And all of that is like kind of incremental or a little bit different than what you're doing, which requires a lot of detailed planning and execution that is all on top of the day to day, right? So where we start is really, we're a private equity, a majority controlled buyer, right? So we started on day one of our 100-day plan is we take the team off site and we spend 3 days really kind of trying to hammer out what is the vision of our company in 5 years. And
Well, well, let's use the example. Let's say that 51 Labs,
Yep.
we're a digital marketing firm and we focus on all private equity, um, portfolio companies, investment banking firms. But let's just say that we're exclusively healthcare focused
Yep.
for our private equity and healthcare portfolio companies. Like, what are the questions that you would want to, what are the questions that you would be asking me in that 3 day offsite?
Yep.
Or
Well,
maybe even pre-deal. we'll just
yeah, I mean,
we'll just
it
say
does
during
start.
the 3 day offsite.
Yeah, I mean, it does start pre-deal, right? Because you really need to have like a strong view of the market, but ultimately, it's kind of driven from the customer backwards, right? So, one way to do this would be, okay, so are there adjacent, kind of product lines? We're addressing marketing, but and is it for the, kind of individual portfolio companies, or do we want to do that, by adding fractional CMOs, or like what are the kind of like adjacent areas that we can add a little bit more value to our core offering? And you kind of explore that, brainstorm. put it on the whiteboard. But ultimately, what you're trying to do is kind of see that 5-year picture. Like, do you guys want to be a full service marketing firm that has fractional leadership, the hands to do the digital, marketing, plus kind of other kind of enhancements and workforce solutions. Is that what we want to be, or do we want to be stick to our exact core business, but offer it to other segments, not just healthcare, but we want to hit kind of industrial manufacturing or something like that, because it kind of has a lot of the same elements as healthcare. So, it really, kind of thinking about what are the ways that we want to grow, and then kind of it's starting from that 5-year vision and working backwards. Okay, what needs to be true in 3 years? What needs to be true next year? What needs to be true next quarter? That's really
How,
the model.
how when you think about the 5-year vision,
Yep.
what are bad ways to think about the vision and what are good ways to think about the vision? Because if you're asking me, like, you know what my vision is? 10x the business. Why not? Do I have any rationalization? No. More zeros for the team, for us as business owners. But
Yep.
how do you start to think about creating a good vision versus maybe a bad or a poor vision?
Yeah, I think it needs to be grounded in the realities of execution, right? So that means to me is like try to keep it pretty close to your core business today. And it's taking a step outside versus 3 steps. So you're a digital marketing firm today. Do you want to become I don't know, a sales guru as well? Like, and also offer all.
Well, here's a good example. We had one of our clients say, "Can you find us 5 junior consultants for our new consulting firm?" And we're like, "Yes, we've placed hundreds of veterans in jobs. We could figure this out for your business." We placed 5 people, got paid 30K a head, 150,000, and we're like, "Okay, that's real revenue." But how do you differentiate between, following the shiny object versus following your customer to a complementary service to the same customer base? Because if you look at the big picture of our business, you have branding work, website, video, LinkedIn, full service digital marketing to private equity and then the portfolio companies. Like, we have an industrial focused private equity firm. We work with 5 of their portcos, going so deep and across these different services. So how do we make that decision of like, hey, explore this other recruiting service, arguably for defensibility and getting stickier into the customer wherever they are needed, versus, hey, that's actually a distraction. Good job on the $150,000 revenue, but that's actually a distraction. How do you have that discussion with your porcos and think through that problem?
Yeah, I mean, I think the way that you're already intuitively kind of laying it out, is the same way that we would do it in terms of it. How are we building, enhancing parts of the business that's going to funnel our customers back into our core business, right? So recruiting, I mean, could do that because but maybe you focus on marketing recruiting, right? Because we're the experts in digital marketing, and we have to hire digital, junior digital marketing resources. We're already good at that anyway. We can offer that client, and oh, by the way, when you hire that junior resource, you're going to want that strategic branding element to help set the roadmap for that firm, and then you have the hands to do it at the company, and we'll help you recruit them. But now, if we're just like recruiting consultants that are like really outside of what we're doing, and it's never going to kind of come back to our core business model, that one I struggle with a little bit. And then the other kind of thought I'd
We
add.
we did cold outreach to 712 early 20-year-olds from Bain, BCG McKenzie, LEK, EY Parthenon, Oliver Wyman. We got them placed, and we have a really robust database now.
Yeah.
It was a
Well, you
lot
can
of
do
work.
anything. You could clean the bathrooms. Like you could figure it out. That's not the question. It's like whether or not you want to spend your, limited resource versus time, and talent to focus on these things. That's the tough decisions. And one of the other things I was going to add is like going back to that 5-year vision for us, it may be the same for you, but like ultimately like we're private equity, right? We have a horizon, and it's 5 to 7 years typically, and so we want to sell. So we are also kind of solving for what does this business that we want to sell need to look like, right? And that we can use, kind of comparison case studies, and other things of like, business X had started with just staffing, but they added outsourced services and they were able to, significantly increase, the multiple, right? So that's also an element of this where it's like, for you, whatever your goals are in 5 years, that's where you kind of need to start and then kind of work backwards plan. So is it exit or is it just to continue to grow? Maybe they're the
Yeah.
same, but they could be a little bit different.
Yeah, because for Jing and I, my co-CEO,
Yep.
co-founder, and wife, you know, what's the vision that we want 5 years from now? I I know that the vision we want or need 30 days from now when she goes out from maternity leave is we need to replace her functions really, really quickly.
Yeah.
And but I think it does force us to ask, what do we want this business to look like for our team,
Right.
for us? And one of the things that really gives us a lot of energy is creating a from to chart for our team and where they're at with their skills and where they want to be at the end of the year and 3 to 5 years. And hopefully we stay aligned because of how much we care about their growth. And it's human nature, maybe, or maybe just ambitious people. They want to feel like they're going somewhere, but you get to the end of your year for your annual, and you're like, what did I just do last year? I did a lot, but what did I do? So it's like, I think we have to go through that exercise for our team and us as a business.
Yeah, I mean, and that could be, kind of what drives like what that vision needs to be is because if you need to, or you want to provide a company that is there's a lot of opportunity for growth, the company needs to grow. And but like a lot of we buy small businesses. There's a lot of businesses that don't need to grow really. And it's a little bit counterintuitive, but they're lifestyle businesses. They are run from to maximize, cash flow to the owner, and they're running the business for that, and they're deciding to not invest in more commercial resources. Maybe they had an experience that they did that and it didn't work. So it's better just to kind of maintain what they're doing and kind of manage the business for that. So again, it all comes back to what do we want to be when we grow up or in 5 to 7 years, and then it's really starting to isolate what are the discrete tasks or initiatives that we need to do or run that are going to make us look different, and kind of achieve that vision.
Where do you find that executives that are maybe hired on to the management team or just the owners who are part of that next chapter, where do you find that they struggle post acquisition, particularly the first year?
Well, it comes back to the same, issue that we were just talking about is that I think that when you're partnering with a private equity, there's an expectation that we are going to be running strategic initiatives that are going to be more transformational, not just like running the business, right? So I think that where people get into trouble, or have challenges, which is very natural, is that we get sucked into just the day to day, and we're not kind of reserving time to work on the things that are going to actually make the business look different, because and oftentimes this is a function of your leadership team, in capacity and bandwidth within that. That's why in our first year of partnership with companies, we're typically adding two people to the management team. The archetype is like generally a founder who is very interested in product, or maybe a transitioning founder that's transitioning it to their number two person, but that person's got like a specific skill set. Typically they're like product people, And we're bringing in a finance person and a head of sales and marketing. Like that, like those are the two things, because typically that all those functions or those capacities were done by one person. Now we're trying to bring in outside leadership that is also bringing their own perspective, their own experience from industry, to take those and own them and run with them. And that opens up capacity and bandwidth to work on some of the more kind of transformational type of initiatives.
On the second pillar with talent,
Yep.
what are some of the mistakes that you feel like you've learned from that have really shaped your current approach to hiring the best talent at management teams?
Yeah. Yes, I'm a veteran myself, and I think that when I was pitching myself to get jobs, I was always saying like, look past the skills. Like, yes, I was a Marine tanker, like not super applicable in like the civilian world, but I was always like, look past the skills. I've got the intangibles. I'm gonna work harder than everybody else. I'm gonna figure this out. It's not rocket science, and got into finance through that, right? So I think that if I apply that to the hires that haven't worked out, is that we got obsessed with the skill set, the experience. They came from the pedigreed situations, but they weren't really they didn't want to they didn't have the same work ethic that developed the success previous in their career, or they weren't ready to go to a smaller company where it is more entrepreneurial, which oftentimes mean like you're doing the work versus like delegating and hiring a big team. So you kind of fall in love with the pedigree and the experience, and you kind of ignore the reality that this is going to be very different. And ultimately, the ones that have a lot of success are the ones who are mid-career typically, and that this is their first kind of bite at the apple from an equity opportunity, and they come in with a lot of fire, and they have had the experience, and this is their first chance to be, kind of had a seat at the leadership team, and tremendously, motivated. So, you always got to rest your hat on skills. I'm sorry, the intangibles versus like the hard skills.
Yeah.
They'll learn it. I have no doubt about that. So, that's our biggest lesson learned.
I think, yeah, one initial thought is I share that pain the past 6 years. Like, you have to be so aligned on uh, company fit and stage
Yeah.
fit and cultural fit. And it's
Yeah.
not a judgment on the company or on the potential employee. It is truly a fit, because some people who are at a certain stage in life might not want to go to that certain size of company and do the VP mid-level work that it takes to go from 2 million of EBITDA to 5. And then you have that full team that you built out over, a year or two. Um, and the second thing it makes me wonder, or the second question I had is for for executives who are thinking that this could be a fit and they've never worked with private equity before and they're excited to go to this size of company and they want equity in a business, like for a business that's, call it 2 to 5 of EBITDA or whatever, like I know it depends on the business, the size and the shape, but like what are their expectations, broadly speaking, in terms of base compensation and equity packages? Because they're kind of, staring into the abyss and thinking it's interesting, but I have no idea what is in the range of market and not.
Yeah, just back to the fit comment real quick. Like that is it. Because everybody is like had good experiences and is good in certain environments and everything like that, but like you have to want to do this at this level. Like that matters far more than any previous successes. And if you do want that, then we are going to, especially for our businesses, again, function of the size, the cash comp is not going to be the same. It's going to be lower than what you could do at a VP level at some big kind of multinational company. That's the reality. But the equity upside is going to be, far more substantial than what you could get at, your standard kind of publicly traded multinational. So that's and again, that kind of ties back into the person that we're looking for wants to bet on themselves. They want to share in that upside that they create. So it's kind of reinforcing in that from that respect.
So why do people do it? One is the equity upside, but what's like a great avatar or a great, you know, picture and demographic of the people who really thrive at the companies that you invest in of 1 to 3 million of EBITDA, where it's a majority control situation? Like, what type of executives succeed in your portfolio?
I'll use a phrase that's pretty overused, but like player coaches, like those are the ones who do the best. Is somebody who is mid-career and not so far away from doing the tasks, that they're not afraid of doing the tasks. So from a sales perspective, we have a company, specialty care management. We brought in a SVP of sales, and he was the number two at his previous company. And they'd gone through a transaction, and he was kind of on the outside. So he was interested in being at the table, but he wasn't so far removed. Like, he was managing a team at that company, but he wasn't so far removed from actually carrying bag and selling, that when he joined and he had a grand total of 0 direct reps, that he wasn't afraid to go out in the field and by the way, he's like, what better experience to like build your team is to go out and do it, and figure out what's working, what's not working. Then you start and you implement you make sure that the CRM and your sales processes and sales operations are built in a way, and then you start bringing in reps and you start scaling the team. And that was almost 3 years ago, and he's got a team of four that we're growing to five, and picking up marketing. It's so like that evolution is there, but you have to want to go back to that, kind of individual contributor almost. And a lot of folks that are 2 or 3 steps removed from that have no interest in doing that. And that's fine.
Yeah. So let's go to this idea of, like, with my co-CEO and wife leaving on maternity leave,
Yep.
we're going to do a red team exercise this Friday on the business.
Love it.
And we have two transitioning veterans from 51 Vets who are going to be leading this exercise. So
No punches will be held.
if you were to red team our business, like, how would you conduct the day to assess the health of the business, the risks in the business?
That's a good question. So, I mean, we this kind of is like the third element of our kind of portfolio program, which is platform transformation. And again, tying it back to the investment thesis, we start with small companies. We obviously need to grow them, but also when they grow, the business needs to look different than when we acquired it, right? Typically, no finance function. It needs to have like a proper finance function. Very, kind of haphazard sales strategies. It needs to have a sophisticated commercial strategy to kind of deliver on the exit that we're trying to achieve. So the way that we do an initial assessment, we use a scorecard, right? And so we focus based off the size of the business that we work in. We're focusing on the core functions, so finance, commercial, and then operations is a little bit of a catch-all. And then we also do strategy and management team. Those are the elements of the scorecard. So we'll do an initial assessment. We start this in diligence. So I think that we would do this, kind of a similar exercise to kind of put together the metrics that we think are important. We've got to collectively agree that these are important, and then we kind of grade them, and then throughout our partnership, we might start at the F level, and we want to be at B's and A's by the time we exit.
So how would you do that for a healthcare focused digital marketing firm? Where do we spend the first hour in just breaking, like, just absolutely going savage of destroying this business?
Yeah, so I think with
If I'm even thinking about this correctly.
yeah, it's a little bit different because I think like you're trying to solve for kind of what's going to break when you have folks kind of off like this is a little bit more of a um
It's
I'll,
one folk creating two people.
right. Yeah, exactly. Where our scorecard is like a little bit more kind of focused on exit readiness and overall like kind of maturation of the business. So where we start with the assessment and we kind of go through the function, for a finance function, right? Are they doing 13-week cash flows? What's the FP&A type of capabilities? Do we have a finance function that you as the business owner can go to them and say, hey, I want to go into, I want to start doing a recruiting business, or I want to offer contract labor. Help me? How do I think through the business model here? Or is it Jordan that has to do all that, right? Like that's like, when we start with a business, Jordan's doing all that. When we get to year 3 or 4, we want a finance function that is capable of doing some of these things because at exit, when we're selling back into a mid market private equity, they're going to expect that there are certain capabilities and capacities that exist within in the business. So it's a little bit different, but I think we could tailor something that would kind of be serve a similar function for what
Well,
you're
it's interesting because you're optimizing for the exit. And I wonder also, like, because some of the businesses you might be uh, partnering with have founder dependency or,
yeah.
so how do you underwrite that risk and be like in your underwriting process, what is your framework just for risk?
Yeah, the founder risk is a tricky one. I think that there's kind of like three models that like the businesses that we kind of target kind of look like. One is the transitioning founder. This is your kind of baby boomer aged founder, and there's nobody like there's no replacement. Pretty risky, but can have some significant upside because typically that founder has been optimizing for cash flow, which means they haven't been reinvesting for growth. So when you kind of have a clean exit, you can bring someone in from the outside, and it's like a smoother transition for change. Um, Now, the flip side of that is that the rest of the organization might have embedded kind of tendencies or also might want to be in that, kind of uh, slow growth, no growth type of mentality. And that's really tough to fix. So that is a risky one. And we really would have to underwrite it under the assumption that, there are like a couple of other lieutenants that would be, in it on the change action. The second model is like the same with the transitioning founder, but there is that clear cut number two person that we're backing as the CEO. That also, we like that a lot because it reduced it. There's like that person is an insider, and they're not going to get rejected like cancer. That sometimes people from the outside do. On the flip side, though, they might have grown up in the business, right? And oftentimes the value that we can bring is we bring in people from the outside of the business because they can bring in fresh perspectives. And then the third model is it is that mid-career, founder who is just looking to sell the minority, the majority shares and take a ride with private equity, and they're going to stick as a CEO. That one on like that's an awesome model. The flip side is they are going to have strong opinions about how to do everything because
Mm.
they are the ones who drove the success and where the business is today, rightfully so. But we make the case, and we do this together, is that if we want to look different than we do right now, we are going to have to do some things differently, or else
Yeah.
things are going to be the same. So it's a tough one. Each one has trade-offs.
So let's talk about how should smaller companies think about incentivizing the employee pool and the non-executive management pool? Because uh we want to incentivize our teams that it's more than just base and bonus,
Yeah.
and that there's a you know not just being more skilled and doing fun and interesting work and all the other stuff that we sell our employees, but how should we start to think about either profit incentives or an equity pool. And this is a company, let's just say it's a company of 1 million of EBITDA. Um, how should we start to think about that?
I mean, the first one you kind of pointed out is having a bonus pool, but make sure that it's tied to outcomes, right? So I think that a lot of bonuses are kind of, year end, like business did well, we're gonna share some of that profit with the employees. But ultimately, kind of being more structured around uh, outcomes lead to bonuses so that you can drive, behavior changes through, having good incentives. That's one element. A lot of businesses are already kind of doing that. I will say also, we see a lot of businesses that are not doing that, that are just kind of at year end. All right, we made a little bit of extra money. Here's distribution, especially at our size range. In terms of like profit interest, I think that this is a concept that we are thinking about how to like be more programmatic about. And I think it needs for us, it needs to be driven off of like generating good returns for our investors, right? So incentives that are aligned with our investors. So is there, kind of a portion of an equity plan that is for non, kind of managers, right? And it's a pool of the plan, of the equity plan, that is triggered based off of certain, kind of return outcomes. That way, when we win, they win. And then the important part of that is making sure that's communicated in a way that's easily understood to everybody. Because a lot of times when you start talking equity and this and that, people's eyes glaze over, and you kind of lose the credit or the goodwill that you're trying to generate to get everybody to think like a business owner. That's really what you're kind of trying to get at. So we haven't really cracked that nut, but that is something that we do we are trying to be more programmatic about.
Yeah, and I think where we can start is more transparency around bonus structure. And like we ask around at a ton of other agencies how they think about it. Some people say we don't even start until this level.
Right.
I think it was like VP or account supervisor, some of the larger agencies, where we'll go all the way down to like the junior most part. But there is not transparency around like, here is the range of bonuses for certain KPIs.
Yep.
And I think we start there. And then that allows us to build into also, things that are profit. Like, well, we have to have profit at the end and enough. Like, we haven't given ourselves a raise or ourselves a bonus as a business owner. We've been reinvesting that. But I think it starts with the bonus structure and having transparency around that. Um,
So just real quick on that is, so we basically have like a profitability target that is, aligned with the budget, and that kind of funds the bonus pool, if you will. So we've got, and that's on a scale, and there's a minimum threshold to fund the bonus pool, right? And that's needs to be communicated in a transparent fashion so that the employees and the company knows that profit matters. And ultimately that's going to fund the bonus pool. And then once it's funded, then you can then you can get down into the specific KPI that person in their function influences. And and it can't be too broad, right? Because somebody in finance is, having them a revenue target. It's like they're like, well, how do I really influence that?
yeah.
And you kind of lose the meaning. So that's kind of our cash bonus structure, is that minimum profit funds the bonus pool. To your point, like we can't be paying bonuses because you hit your outreach targets if the business is, down 50% this year. Like that doesn't make sense. So we need to fund it, and then after it's funded, KPI that are specific to the function that the person does, so that they know that they can move it. And then you also have them on a range, and then so you can, understand why people don't always do this. It does kind of get complex to administer.
Well, I like it because we haven't thought about it. We've paid consistent bonuses and that are at or above our market, and also at junior levels. But we haven't had a minimum profit level above which we will distribute bonuses. Because if we think about it, like, bonuses are conceptually for doing extra, doing more, doing better. And so if they're running more efficient video process or a website process, instead of it taking 8 weeks, it takes 4 weeks or 6 weeks, like that's a more profitable business. And so therefore they should be rewarded through that more efficient effort. Um,
100%. Yeah, I mean, but ultimately, if they fix their little area of the pie and the business is down 50%, you kind of run into some issues. So that's why it's like, kind of trying to work those two things in tandem, and also, communicating about, whether it's a lot of people understand revenue more than profit. So maybe it's a revenue target, and that's where you kind of have to, get, design that plan so that it works for everybody. But
yeah, because the
that's
revenue side, like if we think about our account execution team who does the work of the websites, the branding, the videos, etc., if they are more effective at that, then my co-CEO Jing and I have to do less execution work, which frees us up to do more sales. And maybe the account execution team's effectiveness frees up the revenue opportunity. So maybe the bonus should be more tied to top line revenue, because that as or maybe even because I we can track their hours on a video on a website, and we know this should have taken X and it did Y.
right. Yeah, and then here's the next part of the discussion is balancing simplicity with having the perfect metrics in place, right? So when you can pick two KPIs, pick two KPIs instead of five. And if you can track it easily, okay, great. But if we're starting to do a bunch of manual manipulations to data, then now it becomes administratively, more complex to track. So we always try to go with the simplest bonus structure, but it does, to your point, like need to be tied to what that person is doing and how that person is adding value for the organization. And then ultimately, you kind of have to determine whether or not it's a revenue target or profitability target. Obviously, revenue target can get a little bit tricky, because ultimately, like, you need cash to pay out of it, to pay out a bonus. And at the size business that we work in, like, it's tight, right? Because we are reinvesting almost everything, and we have to be, very, very vigilant on cash management and making sure that we're doing the right things by all stakeholders.
So, so shifting gears over to buy versus build, how do you think about the right timing for your partner companies to start buying and doing add-ons versus just doing what they do better for the next 12 to 24 months and building the business? Because maybe mischaracterizing private equity, but are we bringing a square peg to a round hole and be like, hey, this is actually how you solve this problem? And it's everything is M&A, everything is M&A. Like, does M&A cure all problems? And I asked that because we were looking at buying a business 2 years ago, complementary service directly to the same customer base. And we ultimately decided not to do this acquisition with a retiring founder who we had worked with before on other projects because of following reasons. Number one, being, a 4-hour flight away. Number two, we were like, this is double the size of our head count. So can we even manage this? And then number three, at that stage of our business a couple of years ago, we're like, I don't even know if our own functions are doing well enough. And overall, for these reasons, it's just going to create more headaches and a lot more risk. So how do you work through that buy versus build for the management teams that you're working with?
Yeah, it's a great challenge, because you can flip it on a number of dimensions and kind of talk yourself into doing, this or that. Our approach is, we've got to get the foundation solid. And so the business that we're buying, they don't have a finance function, right? These are companies that are probably not closing on a monthly basis. And they're using outsourced, CPAs. If we were to, like, month two, like, acquire a business when we're, like, still trying to make sense of what our own business is doing, that is not going to be good. So we really focus on building the foundation. So that really means having a commercial model that is scalable and also complementary or makes sense with whatever the acquire company is, but also having like this back office functions of finance, largely finance, but also HR to an extent, at least in place so that there's something to build onto. And that, I mean, it can take 2 years with the types of businesses that we're working with to get that in place. And then, so that's like, can they do it? And then the next question is like, should they do it? And that is really, a question of like, how much organic growth do we think that we can drive? And if the answer is that there's organic runway, then we're typically going to be on the side of not doing M&A, because the execution risk is so high with M&A, which is a little bit like different than, there are a lot of buy and build firms out there and they do great and it makes sense for them. But for us, we're trying to, pick segments of healthcare that have a lot of organic growth runway, because ultimately we are trying to drive organic growth, over top of inorganic. But really, it first starts with, can they do M&A, building the foundation strong, and then it's, should they do M&A, and you start kind of getting into the organic growth runway, but also you get into the factors that you just laid out, like, okay, what's the culture, kind of considerations. Are they East Coast and they're West Coast? Like that creates complexity that you can't ignore. Big businesses, they can like solve for these things a little bit easier. Small businesses, it's harder to solve for these things. Like the time zone difference is an issue. So all of these areas is, it's basically means there's a pretty high bar for us to do M&A with our portfolio companies, which is a little bit different than some of the bigger private equity firms.
Yeah, and it's interesting because I think what I'm gathering is it kind of depends on, do you have the functional foundation first and getting aligned on defining what that foundation is before going off and buying new businesses with all the execution risk that comes along with that. And then, back on the foundation part, it makes me think like, what is the runway and how we fully optimized and executed on that runway? Within video,
Right.
just one service that we do, call it 10% of all funded private equity firms have one video. That's not if it's a good video. That's
Yeah.
just one video. And if, so just the addressable market opportunity there, okay, so we don't need to go off and buy a video focused firm. That's not going to make us better. Like what we do is to hire more for that one service. Um, so I think we covered a lot of ground for episode 1.
Yep.
But maybe one last question for transitioning veterans. You did your own transition, but you've probably spoken with a bunch of transitioning veterans. Do you have any core pieces of advice, tips and tricks for transitioning veterans who are interested to get onto the operational side of private equity and working with the portfolio companies?
Yeah. So I mean, like my broad advice, is actually going to kind of sound similar to the way that we work with companies. That is, you have to have like a 5 year, maybe 10 year vision of like what do I want to do? And as a transition veteran, you talk to like 100 other veterans to get a sense of like what in general does that 5 to 10 year picture look like? And then your first job outside of the military, depending on your skills, I was a tanker, I had zero skills, is to build skills. So, I was looking at finance and consulting because like I need to like learn how to use Excel. I need to build a PowerPoint. Like I don't know how to do those things well. So build skills first. And as long as that first, job outside of the service is not going to take you dramatically down a path that isn't aligned with your 5 or 10 year vision, then do it. Because ultimately, finance, a lot of, finance jobs are generalist enough that if it's not exactly what you want to do forever, I did like high yield credit research. It was not what I wanted to do forever, but it taught me how to do financial modeling. And I was a criminology undergrad, so I didn't even know what a financial model was. And it taught me how to do that. And I understood how to analyze companies. I learned so much about corporate finance. And then I was like, okay, this is not what I want to do forever. And then you start thinking about the next thing. And so you're putting together a path which is going to take a lot of different turns and whatnot. But as long as you're kind of still generally pointed in the direction of what you want to do in 5 to 10 years, then like take the shots, get the experience, and ultimately build skills to add to the intangibles that you already have and build throughout the early part of your career.
I
Uh,
love that. I think that's great advice. So the takeaway I had is have a 5 or 10 year picture, which is created by talking to a lot of people. That's going to give you maybe a low to medium definition version of what the future looks like, and then identify the core skills to execute that 5 year vision, and then just focus on skill development and de-emphasize the particular industry or the particular company or the particular size and shape of the company. Focus on skill development. And as you get into that first job, you're able to iterate and start to narrow the aperture. So it goes from low definition to medium definition to high definition as you get further and further into the job.
well put. I
Teamwork makes the dream work on that one.
that is the playbook. I mean, go into healthcare credit research when it was an internship through one of the veteran programs at Bank of America. I got to the desk and they're like, "There's no jobs here for you, just so you know. This is just for learning experience." And I was like, "Okay, sounds good." And went 2 levels above them and basically forced my way into the department. And it was just to learn skills and ultimately you gotta when you're working 80 to 90 hours a week, like you can become pretty proficient at anything. And but ultimately that's not a really good foundation for later on. I knew it wasn't what I want to do forever, but it helped develop what I want to do. It wasn't healthcare, and I did find that I loved healthcare, and was able to stay in healthcare in every job after that too.
That's awesome. All right. Appreciate the time. And this has been awesome. Went a lot of different directions.
Yep.
All
Well,
right.
good luck to you over the next months, last year. Getting back in the game here.
Oh God. It's gonna be fun. 8 year old, 5 year old twins and figuring out how to grow this business.
Yep.
All right, let's go. All right, thanks so much.
All right, take
See
care,
ya.
John. Yeah.
Bye.